Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. And on today's show, whether it's tariffs or DeepSeek, the word of the month has been volatility. Technical analysis, obsolete, or is there value in price information? Plus a bonus section that I haven't yet revealed. And as always, your questions. I know that our mailbag is pretty full this week. And to help me out is my co host, and you are Mr. X, Thomas. Hello, Thomas.
Good morning, John. Or actually,
good morning for you. Yeah,
I know. I just rolled out of bed a few minutes ago. It's still 3:30 here in Bangkok. So, John, I've been here a while. Hope everybody really appreciates this dedication from me to show up, keep showing up time and time and time again. But no, we got a really exciting show, John. I hope you're pumped about it because I know our audience probably is.
Yeah, I definitely am excited about the show. We got a special guest this week, and just a colleague of mine, and I just feel like it's a really good discussion that we need to have. So I hope folks will get something out of our today's show. But before we get to that, let's get into the meat of our subjects today, right?
Let's do it. And then, folks, if you're here regular, you know that you can ask questions. If you're watching directly on the website, just go ahead and click Ask a Question at the top right. You'll see it in the orange color. And then if you're watching on YouTube, just go ahead and ask those questions directly in the chat. We've been getting a ton of questions every week, which is awesome. And we will continue to try and answer as many of those as possible. All right, John. So it's starting to feel like for the first time in a long time, there's a lot of unanswered questions in the market. Over the last 2 weeks, we've seen back-to-back gap downs on Monday. First, it was the DeepSeek concerns, John, which kind of really punished tech stocks. And then this week on Monday, it was the concern over tariffs. But then a funny thing happened, John. We had the initial sell-off, but then stocks reversed and they just kept chugging along day after day after day. And it just doesn't seem like there's anything out there, John, that's causing a continued sell-off in the markets. So the question to you, John, is do you see anything out there, or can you point to any data that suggests that strength in the selling might continue in the future?
Well, let's just look at first from the bullish aspect, because I know sometimes you tease me about I'm being always bearish, but trust me, I am bullish. I think that, both of those days, when you look at the pre-market numbers or how far a lot of these stocks had fallen in the pre-market, and the fact that they had come back, on that day, I think that is very encouraging for the market. And I think it shows the resiliency of this market. But you remember in our end of the year forecast show that we did in the beginning of January, I said to investors and traders, I said that I think the key word for us to understand is that volatility is going to be huge. And you have to remember, like back in the original Trump administration, that, like you say, anything can happen from day to day. Any word or tweet or something that could send the market, tumbling. But the resiliency is certainly there. So, but this is what I do see, and could be a concern to me. But I think, first of all, let's go to, let me do this first. So here's our Mag 7. And what I've done here is I've gone into our performance page. And you can see that this is kind of interesting, Thomas, that 5 of the 7 Mag 7s are actually down year to date. And really, Meta is the only outperformer, which is just totally ripping today over the last 2 weeks. So, this kind of tells us that if the market is still holding or still, chugging forward, as you say, it's not coming from these high concentration stocks, which is a good sign. This is telling us that there is a potential rotation in the market. And if we go to, here's another watch list that I have, is the S&P sectors. And what I see here is that, some of these equal weights, right? These ETFs that don't have this high concentration or this market capitalization concentration, they have been some of the best year-to-date performers. And it's especially when you compare them with their cousins, those market caps. But if we look at the equal weight versus, let's say, the index itself, you can see that, it's outperforming a little bit, but they're relatively the same value. And when I look at the stock itself, excuse me, the ETF itself, in terms of the chart, what I see here is, here's our 20, 50, 100, and 200-day moving average. Now, in the short-term and intermediate area of our moving averages, you can see this convergence of our moving averages. And I don't think this is anything ominous. I just think this is just telling us that we're in this kind of this time of consolidation where markets are going to fluctuate up and down, but they're going to continue to revert towards this mean. Now, what I am concerned about, and what I am watching over the last couple of weeks, is this is the 10-year Treasury yield versus the 3-month yield. And what we can see here, that it is narrowing, or what's called flattening. And so that is the bond market's way of telling us that they see slower growth. And if that's the case, slower growth is not something that is going to be very beneficial for the stock market. So let's sum this all up. I just think the market is just in a volatile mood, depending on all this new information that is coming out of the new administration. And, if you're trading and you get one of these volatility moves that are in your favor, then, you should be looking to close, that Glenn Ross movie, which I love, Always Be Closing. And that just being aware of this volatility as more of an opportunity and not a risk. Okay?
Yeah, great segment, John. We'll continue to see how this kind of plays out. I know people are kind of, they're getting a bit antsy, John. They want the market to really just break out with a no questions asked move, right? Like either up or down. People just kind of want to get that out of the way, John, so they can kind of continue to track it from that point.
All right, brother. You ready for our guests?
I am ready. So our longtime viewers know, John, that we occasionally like to bring on a special guest. We have Bar Chart, John, both you and I, we get to work with some really, really smart people who have insights in different markets. And this week, John, and I thought this was pertinent because we've talked a lot about TA on the show. Those of you following us on X know I like to share some TA as well on the account. But John, there's a debate, okay, between people, which is whether TA actually works. We have some who swear by it and some who don't. You obviously do. You love it. You share it on the show constantly. But then, John, there are others who may not feel as strongly about it as you do. So our special guest today to talk about this topic, as well as a few others, is none other than Mr. Darren Newsom, who writes all the time for us. Hopefully you guys are checking out his amazing articles on the website. Darren, thanks for joining us today.
I appreciate you having me on, and that was a very interesting segment to start this program with.
Well, I appreciate it, buddy. Listen, Darren is a colleague and a contributor, as Thomas says, and and again, Bar Chart's market analyst. And so, I asked Darren on because I think there's a discussion on what we want to go through is, does technical analysis have value, or is there a predictive aspect or powers to past price into predicting future prices? And so what I really appreciate about Darren is he has some very simplistic rules of the ways to look at the market. Now, I think that Darren and I don't always see eye to eye on all things technical analysis, but I do believe that both of us believe that technical analysis is evolving and that there is some value to it. So welcome to Darren. And so let's just jump right into it. What is your philosophy about technical analysis? And do you believe that it's outdated?
Yeah, and that in a nutshell, that is my philosophy. I started in this business a long time ago, and one of the first things I did decades ago was teach myself technical analysis. I also had a mentor that kind of walked me through some of the early things, and then I set about teaching it myself. And this was back in the day when everyone was floor traders, and floor traders all looked at the same charts, and we were filling out charts by hand, and so on and so forth. So but it's changed, and just going back to the opening segment, where you and Thomas were talking about, each Monday we come in and we're seeing gaps down. That's not technical. Those aren't being done because of technical patterns. That's being done in what you called information coming from the new administration with the U.S. administration. I have a different word for it. But the bottom line is it's not technical analysis. It's not technically driven. But then when you showed those charts, one for the Treasury yield and one for the S&P, what we're seeing, if we want to distill this down, and really this is what the evolution of the market is doing, what evolution of technical analysis is doing, is it's taking it back to the very basics. Trend, price direction over time. And the definition of a trend, like with what we see here, is lower lows and lower highs. That's a downtrend. Regardless of time frame, we could take the title off the market as far as which market it is. The definition of a downtrend is lower lows and lower highs. And so, really, this is what we're coming down to. What basically is just what is the price direction over time? You mentioned my rules. First rule of markets, don't get crossways with the trend, because the trend is being set by these large international investors, most of them being driven by algorithms at this point that don't look at classic technical patterns. And I like to call the group Watson, based on the old computer programs. What Watson does, how Watson changes, and what we're seeing again, just as we did the first time around, is Watson's being manipulated by headlines and keywords and tweets and these sorts of things, leading to what's happening, what we're seeing in the markets. You mentioned what happens on Monday, and then the markets bounced back. Well, what happened? Well, all of the talk of trade tariffs and this sort of thing was, quote unquote, delayed. It never was going to go on, but the market was fed that information. It dropped down. Again, taking it away from technical analysis, fundamental analysis. It's something different entirely at this point.
So listen, I kind of agree with what you're saying, but I still believe that, these algorithms, right? And this is kind of that, I think you mentioned this one time, is chicken and the egg. Is our algorithms trend setters, or, are they trend followers? And so my argument might be is that, isn't there data that they look at that we can look at to help us with our trading? That's kind of that, that art of war. If you learn the tactics of your enemy, then, you can use it to your benefit. Now let's talk about, let's say something like that is very, subjective or arbitrary. Let's say a trend line, right? Well, a trend line or a moving average, even like I did here. These are just, that technical analysis are based on, a rate of change. So can that rate of change, or that ideal of those, again, a trend line is very subjective depending on how you draw it, and moving averages, are arbitrary based on the time frame that you're looking at them. But they do represent something, and to me, I think they represent price discovery. And so if you could use those pieces of information for price discovery, then that helps you in your process. And so for me, technical analysis is more about the discovery of this evidence, right? And this confluence of these different indicators. Because what I'm really looking for is I'm looking to leverage probability. And if I can just get a very small percentage of probability on my side, favorable to my side, I know that I can leverage that into a 10x or 20x in potential profits. And also it'll help me, mitigate some of my risk.
Yeah, you raise a number of interesting points, John. I'll start with the trend line. Basically, trend lines are meaningless because, as you said, it depends on where you started from. It depends, it's everything's subjective. What do you count in? Is this a break? Is that a break? And, with the coders that I have talked to, none of them look at trend lines. Now, you also mentioned moving averages. This is a key component of many of the algorithms, I think, that are trading today. The question is, which ones? I mean, is it as simple as saying 50, 100, and 200, or the 500 and the whatever? Or are we advanced enough? I mean, we could go back to the book that I taught myself, that I read to teach myself technical analysis. And this was John J. Murphy's Technical Analysis of the Futures Markets, way back in the 80s. And he has a section on moving averages. Back then, you could break it down to make it, different moving averages for every market, every time period. So, if you're looking at daily, weekly, monthly charts. So I think that's fascinating. And that's part of this new study. Is it technical analysis? Yes. Is it classic technical analysis? No, because we don't know. And as you said, from the art of war, know your enemy. But we don't know. We don't know what's built into these algorithms. All we can do is study their moves over time. What happens when it crosses 100-day? What happens when a 200 days cross? Or if it's just as simple, we look at closes, based on the idea the only price that matters is the close. What happens if we close below, say, a 4-day, 4-week, 4-month close, or take out the previous low? That's when things get interesting, because then we're talking about, again, the mathematics. We're talking about moving averages. We're talking about momentum. Obviously, as you mentioned, we're talking about increased volatility, and this plays a role in the computer algorithms as well. Are these components of technical analysis? Yes. Are they classic technical analysis where people are looking for different types of reversal patterns or head and shoulders and these kinds of things? No, it is not. And those things that basically can be thrown away.
So I agree with you. I think that old school technical analysis, that traditional head, like you said, head and shoulders. I mean, this is kind of that human aspect of technical analysis, right? That, human data fitting, seeing patterns and randomness, market sentiment, whatever you how to define it. But yeah, I think you're right. The new school is about this, this mathematics, right? The volatility, Bollinger Bands, average true range, percentage change up or down. These are the DNAs of these algorithmic programs, right? So in that case, then history, right? Past price performance, like you said, when the market comes to these values, remember there's kind of this adage that, price remembers, right? One of my favorite tools is gap fills. I love gap fills. Well, a gap fill usually comes from some change in fundamentals, either real or perceived. But the market remembers those gaps. And when it comes to those gaps, these algorithms look for it. They hunt them out. And then that's why you get these crazy reversals in price. So, again, I believe there is this evolution that has come with technical analysis. And it is a lot different from, let's say, you say the classics, of head and shoulders. But it's still about understanding where the market is putting risk on and where market is putting risk off. And that is based on these past price histories, right? Again, I know that you look at some very simple price histories, but when price gets to, let's say, an all-time high or a new high, right? That's when the algorithms, will try to push the market higher, right? Maybe even push prices outside of their valuations, right? I know of an algorithmic programs. You said that you've talked to programmers. I know of an algorithmic program. It's called Seek and Destroy. And this one is designed to make a new high or new low in whatever time frame that it can do this in. And the purpose of this is it's seeking out the path of least resistance, or it's looking for that opposing force that is going to reverse price in the market.
Newton's first law, which is again, we talk about how we revert as we go forward, as we progress, we actually revert. But Newton's first law still applies. A trending market will stay in that trend till acted upon by an outside force. And so what we see happening, as you mentioned, okay, so we've got some algorithms who are buying as markets go to new highs. I mean, we can look at gold, even though there are some other reasons why, investors are still buying. But we can look at gold and we see these algorithms are still kicking in. They're still buying because, it's the momentum, and momentum, again, is a mathematical calculation that can be built in to these algorithms. And so, you've got momentum going up. And so as long as there's not, this wave, that starts to put some resistance in this path of least resistance, then, the buying is going to continue up until the point it doesn't. And at that point, that's when it changes. And what's difficult now, what's more difficult now than what it used to, back when all of the same, floor traders and pit traders and all this were standing around looking at the same charts, same support, same resistance lines. This is where the sells would be. This would be where the buys would be. We don't know that now. You mentioned gaps. I think gaps are a lot less meaningful now than they used to be. And again, as you and Thomas both mentioned right off the bat, we see gaps down. It doesn't mean anything. It's not like it's a breakaway gap. It's not like it's an exhaustion gap or anything like this. These are just trades. And then they come right back and fill when the headlines change or the keywords change. So again, I think there's certain aspects of technical analysis. The mathematical side of technical analysis is still valid. Otherwise, it really just comes down to what's the price direction over time, and then trying to find when that price direction changes.
So if mathematics is the DNA of algorithmic programs, then those components or those fundamental mathematical principles that drive these algorithms, they could be tools for us. Yes, right?
Absolutely. The problem is, how many algorithms out there? How big is Watson? There's thousands, millions of different programs running at any given time. And there's no way to know. It's just like, back in the day, you could read the psyche, the psychology of markets, of human traded markets. That was much easier. You all you had to wait for was for the point of capitulation, and then you knew it was going to go the other way. But there is no psychology to the computer trade. So, every algorithm can be made up of thousands of different pieces of mathematical equations, and another one is similar but different. And here's the chaos theory. You talk about previous price activity, but here's where chaos theory gets interesting, because if there's one difference in the structure of these algorithms or price, the things that are feeding into the price, then you can expect a changed outcome. And so it makes it impossible right now really to get a read. We can start to narrow things down. Maybe it's the 75-day and the 85-day, whatever it might be. But we can start to winnow this down. But then we have to keep in mind that maybe it's just market specific.
So this is kind of where we differ. So here's Fibonacci, and Fibonacci is really a mathematical principle. And I do believe the algorithms use these ratios and these principles, in some of them use them in their DNA. So we did Darren, just to let you know what we're looking at here. This is the GLD, or the gold index ETF. We did a Fibonacci extension on the basic classical way you draw it, and that the first extension would be the 61.8%, and that's represented here by the blue line. Now the market did go past that line just a little bit, but notice that, as far as a closed basis, and I listen, we drew this line in our show weeks ago. Look how the market reacted to that line. So there is value in this mathematics. And so what I would say to you is, there's this kind of like this ghost in the machine, right? In the math, this consciousness in math. And if you understand that, then there is value in the price that is being presented to us, or that information, like you say, price over time. To me, it's really what I'm seeing here is this clue or evidence of this imbalance, or in this case, balance between buyers and sellers.
But again, I mean, and I agree with you, John. I mean, but think about Fibonacci. Fibonacci is a classic mathematician. This has been around for centuries, and we see it occurring in nature. And so, this is, it's again, naturally something that would be built into the algorithms from a mathematical point of view, that we start looking for these golden ratios and everything else that Fibonacci talks about. And so again, to me, this is what's really interesting to me. Again, I still consider myself partially a technical analyst, but what we're talking about, what really still works, is Newton, first law of motion, and Fibonacci, classic, historic mathematician. This is what This is what's driving the markets these days. This is what works in the market. And that to me is fascinating. And certainly, as you said, we can build on this and we can watch this and we can use this in our own strategies as well.
So what I'm hearing from you and what I believe as well is that as we evolve in technical analysis, that the simple fundamental principles and not more of this past the more complex, right? So there's power in simplicity and I would guess illusion in complexity. Would that be a fair assessment?
Yeah, I don't know what great philosopher first said, the famous phrase, keep it simple, stupid. But I've certainly taken that to heart because I certainly fit that description. As you mentioned, I like to look at things as simply as possible, reduce as much noise as possible. And if we can break this down, to simple trends, price direction over time, and we can apply Fibonacci retracements. Again, it kind of, it's predicated on being able to spot a reversal, and then using simple definitions of lower prices and lower lows and lower highs as a downtrend, higher highs and higher lows as an uptrend. These are the things that we can use. These are the things that date back centuries. We could go back to candlestick charts from Japan hundreds and hundreds of years ago. And again, it's based on simplicity. And so I do think the more we progress, the more we actually fall back to a simpler way of studying markets.
All right, my friend, I appreciate it. I think we could probably talk about hours and hours, but I would have to have a few beers to do this. Thanks again for spending some time with us. Folks, check out Darren's articles. You write one about every day or every other day, right?
Yeah, correct.
Tell folks where they can find you too. I know you do some social media as well.
Yeah, easiest way to find me is just to go to thebarchart.com and go to the news and look up the writers, and you can find all my writings there. Occasionally, I'll post something on social media, but the easiest way to find me is just to go to barchart.com.
All right. Well, we'll look for you in the future, my friend. Thanks for spending time with us.
I appreciate you having me on.
All right, Thomas. I know we went a little over there, but I just find that discussion very, very fascinating.
That was a good debate, John. That was a great debate.
Okay.
All right. So John,
you were going to pick the bonus subject today. What is our bonus subject for today? I'm not prepared, but I'm going to go.
We're going to wing it.
Yeah.
So last week, John, we talked about a stock, arguably maybe the second hottest stock in the market. I was going to say the first, but I think Meta's taking the crown for the hottest stock in the market right now. But the stock is Palantir, John. We talked about, its strength in the market. We talked about its upcoming earnings move. You gave out an options trade for anybody who took that trade, they've done pretty well. I think they're pretty happy. John, Palantir is just a beast. They soared on earnings. It was 20%. I think it was the second or third largest gain in the company's history. John, you were kind of in wait and see mode in the 80s, but what are you thinking now?
Listen, to me, it's gone too far too fast. I mean, I look at the valuations. Yeah, I mean, it's just crazy if you look at valuations. And again, I'm not going to step in front of this freight train and say that this is a stock that I would sell. But if I look at their earnings, their forward earnings, and based on the market cap valuations, I mean, you're looking at some numbers that you just don't see. But let me throw it back to you. Charlie Munger, Warren Buffett's sidekick, basically said, and I'm paraphrasing, he said something like, he will continue to own a stock as long as he's willing to buy the stock. So my question for you is, you were the one who like this stock, right? And you said that, you just were tired of seeing it going up, 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 and up. And you were like, I'm just going to buy this and jump in.
Yeah.
Well, would you buy it here at $110 or $115?
I think I would not, but I could. I could. John, when we talked about this, I don't know if it was like maybe 2 months ago, there was a question: has Palantir run too fast, too hard? That was the question, John, that came up, and I said I don't think so. I on that show I said I don't think so, and I explained my strategy for Palantir, which is, look, I don't understand what they do. I don't understand the valuations of the company, which I think have gotten a bit out of whack. But I'm tired of seeing the stock go up. So I'm going to buy it, John, just as an emotional, have you heard this term emotional hedge, John? Just so I can like look at the stock every day and be okay with it, right? I need to be okay with this and cover it in a way that doesn't make me very upset. So I bought it. I'm gonna continue to hold on to my shares, John. I have no intention of selling them whatsoever, because if I don't understand something, John, I'm just gonna ride it because I feel like I'm missing something. That's my general
So here,
outlook.
you're going to buy, invest in it, but maybe what you might do is trade around your position that you already have. Is that what I'm hearing?
Yeah, maybe trade around. It's full disclosure, it's a pretty small position. This is just something that I put on so that I can
Right.
keep my emotions in check as I cover it. So I'm happy for the company's success.
But
The
here it is. It
CEO,
was $70 back in December. Now here's 110. So I mean,
crazy move.
great, good for you. Good score. All right.
And
Listen, I know we have a lot of questions. Let's get to them
yeah. For those
today.
of you out there holding Palantir, congrats on your
Yeah,
success.
congrats.
I know you
Hey,
guys
if you
are
took
very
that call strategy that we set up, boy, that turned out to be, that was like an instant winner, right? How bad was that, right?
absolutely.
All right, so let's get some questions.
All right. So, John, on last week's show, we covered gold, we covered the GLD ETF, and a question came up, and I think it's beneficial for everybody who watched that show, which is, you pointed out that the gold ETF was trading at about a $20 discount relative to spot price. So the question is, okay, so what? Like, what is the significance of that point, John?
So again, when we were talking about gold and the the GLD, the gold ETF, it was originally designed to represent about 1/10 of 1 ounce of gold. So here we are in the futures market. But if I go down here to where it says futures prices, we can see that the cash price for gold is $2,860. So 1/10 of that would be $286. If we go to the GLD, now the reason why you're going to see this dispersions between the two values is just the basics, the mechanics of trading a physical ETF and this idea of that markets that are in contango where the front month is the cheapest or the forward month. So every time you roll forward, how you protect or hedge that position, you kind of like a negative dividend. In other words, it decreases a little bit from that value as you have to buy the more expensive contract. But you can see here the GLD is trading at 264. Well, that's right. 284 minus 264 is $20. So it's trading at a $20 discount to the 1/10 of 1 ounce of gold. Does that make sense, Thomas?
It does. It does.
Okay.
John. All right. Next question, John. Is an options play on the VIX the best way to capture change in volatility?
Yeah, this is like playing craps on craps. So what is the exact question here?
If you
what's
believe
the
that
best way to play
volatility,
volatility on?
Yeah.
First of all, the VIX to me is really a tool for you to kind of measure volatility in terms of not really trade it. And the one thing I do know about, even when you're in a volatile time, the VIX will revert back very quickly. In other words, there's not a lot of price movement in one day. You can see, look, here we went from this is a daily, well, this is a weekly chart. Let me go to a daily chart here. Right, here's where you had like a low VIX around 15, and then boom, one day it shoots up to 20. Well, within 3 days, we're back down to 15. So I think it's very dangerous to play. But I mean, I could look at, maybe a volatility measurement on the VIX. In other words, let's say, what do I have up here? This is the S&P here. So let me turn this off for a second. Yeah. maybe what I would do is look at, maybe like a moving average or a MACD crossover to give you that buy signal, or look at another volatility measurement, like for instance Bollinger Bands. Wait for that breakout. Wait for the bands to come into contraction and wait for that breakout. But again, what are you playing the VIX for, right? Certainly, as an option play, it snaps back so quickly. So again, it's not really something I do, so I can't really give you an honest answer, but or a straightforward answer, I guess. I always give you honest answers, but in this case I would say it would have to be something very, very short term, and you'd have to be very, very quick in terms of trading that. You have any ideas on options? This is kind of your world, right?
Yeah, I really don't trade the VIX. It's fun to observe trading activity in the VIX, John. We've covered this trader. His name is 50 Cent Trader, who sometimes comes in with these cheap call option plays that are 5 to 6 months out, anticipating there might be a volatility surge in the market. Those are kind of fun to talk about and discuss the implications. But I don't really trade the VIX. If there's other ways to manage your portfolio, if you believe that volatility is going to be a factor.
So again, you're like me. You kind of look at the VIX as a tool, but not something that you would trade.
Exactly.
Okay, great.
Let's see what we got here, John. John, is there any predictive value in exponential smoothing?
Well, I think I have a good example of this. Let's do this. I think it really depends on the trader, but I do like exponentials because it kind of no, I might have deleted this one, to be honest with you. Let me look and see if I can find it. I'm just seeing if it's in here. Yeah, here we go. So the way I look at it is that an exponential moving average really kind of captures the in the moment, right? The in the moment, so it's more sensitive to current price. So I like that when I'm kind of like day trading or I'm momentum trading. But what we can see here, this is a exponential moving average. And then we have, the pink is the exponential. And then you have our more simple, we have all three of them, the weighted and then the exponential. And you can see that when the markets are kind of trending or when they're in that same, whatever that market direction is, as kind of as Darren would say, in terms of statistical data, there's really not much difference to them. It's when they diverge, right? When they diverge, and when one of them the exponential gets way ahead, that's where I think the information comes, right? In terms of that technical analysis. This tells me the market has gotten too far too fast, or that when, let's say, price breaks the exponential or returns to it, mean reversion, that there's probably a higher probability we're going to go to the other two. So I think that's where the value is in terms of determining, an exponential or a weighted or a smoothing moving average. I look at exponentials at lower time frames, but if I'm looking at a much higher time frame, if I'm an investor and I'm looking at weeklies and monthlies, then I think a smooth, a regular simple moving average is just fine.
John, do you think today's jobs numbers will have a lasting impact on the market?
No, like we said, market discounts price. So whatever that number was, it's already been discounted in the market. Now, I think what could have a lasting effect is if we see a strong economy, right? We see less and less people going on the dole, so to speak. That a continuation of that, I think, will have a more impact on the market. One thing we have to think about, we talk about the uncertainty of moving ahead and the volatility of this current administration. Well, they're asking government employees to leave their jobs. Well, if you look at the employment data for the last 2 years, the government has been one of the top hires over the last 2 years. So that could be a dynamic change in the economy, is if you have more of these people are either unemployed or just going back to their second job now that it's their first job.
John, does a positive bar chart opinion correlate to a positive earnings announcement?
Not necessarily. You got to remember now. So here's Palantir, right? It doesn't really matter what we look at. We can look at an ETF, we can look at gold, we can look at whatever. When you see the bar chart technical opinion, and I want folks to understand, because we get this question a lot, right, Thomas?
Yep.
Is that this is not from the aspect of an earnings, right? Or what the corporation does. If we go down here, here it is, earnings, analyst ratings. This is the analyst ratings. They're rating the company based on what they believe are earnings and revenue and all that kind of fundamental information. The bar chart opinion is based on technical analysis, and it's based on 13 pieces of information that are over multiple timeframes: short, medium term, and long term. And what is the common interpretation of that analysis? Now, for instance, here's a 20-day moving average. So if the stock price is above the 20-day moving average, that is interpreted as a buy signal. So we look at all of these, we commingle them together, and we come up with a percentage value. So if you have 100% technical opinion, just means that all of our indicators are signaling either 100% buy or 100% sale. Okay.
That being said, in the case of a company like Palantir, which just had blowout earnings, John, that move on earnings then flowed into the stock price, which then can potentially impact the bar chart technical opinion. So it's kind of like a little bit of a self-fulfilling prophecy, right?
It is a little bit. And then notice that it says we're in the top 1% of 1% of both strength and direction. Now, this is a good tease. We're going to do this. We're going to do a webinar on this in 2 weeks. We're going to actually break this page down. But a lot of times when you go to the main page, well, you'll see what it says that, okay, yeah, we're in the 1% technical analysis, but the market is highly overbought territory. Again, you can be overbought for a long period of time, and beware of trend reversals. So it's really kind of giving you that warning sign as well, too.
John, any thoughts on oil?
Yeah, oil market is really trying to rebalance itself. Again, day-to-day data, it changes from moment to moment. What OPEC's going to do, what a tariff's going to do, what's going on with Iran. China is Iran's largest buyer, right? The administration wants to squeeze Iran down to zero exports. I think right now they're down to about 1.5 million barrels a day, which I think China takes out 1.3 million barrels of that. So who does that hurt? Well, it hurts China. So what does China do? Well, do they retaliate with tariffs on us, right? So, the market's trying to rebalance that, right? We use a lot of Canadian crude, even though, we still import oil. We import almost all of their crude, right? So if we're with a tax on their crude, then they got to find another avenue to sell their crude. So the market's trying to rebalance. It's trying to figure all of this out, and it's very difficult. And as far as I'm concerned, in terms of crude oil, I got to think that we got to watch, again, what is going to happen with the dollar, what is happening in global economies, and what is going to happen with, all of these potential tariffs. To me, again, I think we looked at crude oil a while ago. I said that the market had gotten a little bit ahead of itself, but I think in the long run, there's still going to be this demand, right? Because the green energy transformation is not happening as fast as everybody's predicting. So I'm still bullish on energies. I would rather look at natural gas than crude oil. But, if China's not doing well economically, if there's an economic turndown in Europe, that will be detrimental to crude oil prices. But I'm still long-term bullish on the market. And you can see we've kind of gotten away from ourselves outside the Bollinger Band's volatility. Now we've reverted back to where we broke out. So that's kind of really where I thought the market was going to come back to. Because below here, what's going to happen is the mechanics of the market will say, hey, I can't drill a well for less than $70 a barrel. And then the fundamentals will say, well, you could say drill, baby, drill, but production is going to slow down, and then that will make prices go back up again.
Let's see, John, are you familiar with a stock called Black Sky Technology?
No, I'm not.
Okay.
Do you have a symbol?
The symbol is BKSY. Our buddy Wayne was curious if you had any thoughts.
Wayne, what's up, brother?
Wayne always comes up with these unusual stocks.
Yeah,
John.
Wayne. Let's see. Geospatial intelligence.
What does bar chart opinion say about it, John? That's what I want to know.
You know what? It doesn't have an opinion. That means it hasn't been trading for more than a year, right? Or 200 days. I think that's our criteria to get opinion, right?
Yeah, that makes sense.
Right? So it's a relatively new stock. Looks like it's coming up on a year, though.
Yeah, looks like it's having a good little run here to start 2025.
Yeah, I mean, Wayne, you got nice momentum here, but look at the volatility now. It's getting a little bit crazier, right? You know, when you get big price fluctuations, it's usually a signal that you're near a top or a bottom. So probably, maybe a little bit of a correction in this one. Let's look at this in terms of our volatility. Yeah, look at that, Wayne. Right, there's your clue right there. One whole candle outside of the Bollinger Band, and now we closed inside, so there's a higher probability in terms of volatility that we're going to revert towards the mean. Now, there is a little bit of a gap here, and if this is a strong uptrending market, it should hold that gap, which would be halfway between your mean and your outer band, which would be a positive sign. Okay, great.
John, without going too in depth, because I know you could probably talk about this for 2 hours, can you name your top 3 favorite indicators?
I love Bollinger Bands. I love average true range. And I know this is old school. I love volume. I think volume is just a great indicator. So that'd be my top 3 if you ask me. But it's like, asking me what my favorite Grateful Dead song is. Every day it's 3 different ones. So, but I would say consistently I use Bollinger Bands, average true range, and volume.
And we have webinars, many webinars on each of those topics. If you guys go to our YouTube channel and do a search for those, you'll be able to spend the entire weekend and more going through those. John, here's a general question that somebody sent in, which is, if you buy a stock based on what you perceive as really strong fundamentals that get you to buy into it, and then the stock proceeds to drop by about 1/3, what should your strategy be at that point? Should you just kind of sell it and run, or should you stick with what you believe? What do you think?
Well, I have a definite plan, a trade plan that tells me what to do before I enter in the stock to tell me when I'm going to get out of the stock. Now, in terms of investing, I will never invest more than 5% of my total investing portfolio on any particular stock. I usually start out like at 2%. But if I set a risk of about 2%, in other words, if I lose 2% of my total portfolio, then that would be a sign for me to exit that trade. Now, what does that usually mean in terms of the stock? It depends on the price of the stock, again, and the timing of the stock. But, if a stock loses 20% and it is exhibiting the characteristics, I guess Darren said, of lower lows and lower, a great example would be Oxy, right? This is one of the ones that we had been following. This is one of the ones that we've been following. It's not coming up. Come on, let me change it to here. Oxy. There we go. It's just not picking it up today. All right, let's try one more time. One more time, Thomas, and then we'll move on. There it is, Oxy Potential. All right. Right. Once I lose a certain percentage, and that's it, I'm out. Boom. And that was predetermined before I got into the trade. Now, remember, we looked at this one and we said there might be a reason why we could come back in this, but it hadn't changed the characteristics of making lower lows and lower highs. And what have we done since then? Well, we did make a lower low. We made a lower high, and now it looks like we're trying to make a lower low. But if we hold here, then this might be an opportunity to get back in as this transitions from a downtrend to a potential uptrend. So a couple little bonus there for you. Again,
I think your advice, John, about having the plan and the strategy before you enter the trade is the most critically important part of it, right? Because then you're not reacting emotionally to what you see occur after. You already had your strict strategy. And, famous quote, John, I know you love it. I love it. It's from Benjamin Franklin. Failing to prepare is preparing to fail, right?
It's a preparing to fail, right? And all trades start with a stop. Just remember that one.
Exactly. Hey, John, I want to show our viewers one thing. Can you go back to Black Sky, which is BSKY? I just want to show folks something here. So the reason we don't show the bar chart opinion is because this is a lower. I think that should just be the BSKY on the. Is that the Canadian? I think it's just.
That's a Canadian, yeah.
Okay, so the reason we don't show the opinion is because it's a lower cap, John. But if you go to the technicals on the left-hand margin and click on bar chart opinion, up a little bit. Bar chart opinion under the technicals.
Yes. Sorry, I was just reading this one. Okay, yeah. This does that.
So 200 days of trading activity. But if you don't see it for whatever reason, you could just go ahead and click on bar chart opinion on the left-hand side, John, and you will get it to come up.
Click on this again.
Yeah, bar chart opinion. All right, we'll figure that one out later.
It's the wrong symbol. That's why. Sorry, it's not blue sky carbon. Okay. All right, move on. It's almost time to quit. I'm ready for a Friday cocktail. I don't know about you, brother.
Let's finish it off with one last question, John. Nat Gas, what are your feelings? I'm pretty sure you're gonna say you're bullish.
Yeah, I'm very bullish, and I'm long-term, short-term, intermediate. I think the market. Again, one of the things I said, you got to look in the 15 days out. 15-day forecast is actually colder than normal. But also I said that you got to start watching inventories. Well, inventories are drawing a lot faster than that we had anticipated. And in terms of looking at what's going on in the foreign markets that it relate to natural gas, this is just continuing to rip. And this is what our natural gas turns into LNG, and then it's sold in Europe. And this trend is not. This is LNG in Europe. This trend is not over yet. So all those things are bullish. So I'm bullish in the short term. I'm bullish in the intermediate, and I'm very bullish on natural gas in the long term.
All right, John. You're going to kill me, but I want to do this one last thing because.
All right, one last one.
Fired. The symbol BKSY. I just want to make. I want to make this.
KSY. Okay.
Black Sky Technology.
All right.
Now click on the price overview page. All right. So we do not show the opinion because this is a lower market cap, John. So we don't want to be seen as promoting small caps. So we don't show the opinion. However, if you click on bar chart opinion on the left side, you will see that come up. So just everybody out there, keep that in mind.
Thank you, our crack staff behind the scenes. Thank you very much for that answer.
You got it. All right. So, John, we've been on a 5 straight week run for MOC. It's been great. We've covered a lot of things, but I think the time has come for you and I to take a much deserved reprieve. So we're going to be off next week for President's Day weekend. And then we will be back on Friday, February 21st. How does that sound for you, John?
That sounds good. One last prediction. Who do you like in the Super Bowl?
Boy, oh boy. I kind of like Philadelphia, I think, you know, they were in the Super Bowl 2 years ago. They came so close to winning. I feel like they've paid their dues, John. They've made a return. They're looking stronger than ever. And frankly, I'm just tired of the Kansas City Chiefs, John. I really am tired of them.
Well, listen, I'm a long-time diehard Giants fan, and there's two football teams that I always cheer for, and that is the New York Giants and any team playing the Philadelphia Eagles. So I'm going for Kansas City. So leave it at that. All right, folks. I hope you enjoyed today's show. I hope you enjoyed Darren. I know that was kind of that. I did that for myself. I'm sorry if you didn't enjoy it, but I really feel that technical analysis is really evolving, but the point was keep it simple. All right, until next time, the best of health, manage your risk, and the good of all trading.